Wall Street bought up homes, drove prices up 100%, and now they're bailing, leaving entire neighborhoods at risk. Does that sound familiar? Here's an example. In Atlanta, investor purchases were down 60%. Values in some zip codes are down 7 to 10% year over year. And up to 24 million homes are owned by investors. Okay, first question. Who are these investors? Just because it's an investor doesn't necessarily mean it's at Wall Street. What do you guys think about this? What do you think about this sort of artificial bubble that the data is claiming that's happening again in boring ass single family houses, which is an asset class we don't like? Do you think there's validity to this?
I think it could be true. I think that prices have risen pretty quickly since the bottom in 2012, right? You've seen prices grow. You've also in the recent years seen expenses grow pretty significantly. So holding these portfolios, I mean, when an institutional buyer buys homes, they're not looking at a single family homes. It's like apartments. It's like apartments with each one's got a roof, right? In other words, they're underwriting hundreds of these.
They're buying 100 at a time.
Exactly. So so it's like buying an apartment complex, except you have multiple roofs and HVACs and all those things. So it's actually, I think, like a tough investment unless you have huge opportunity for appreciation. But right now, prices are high and costs are high. So I can't imagine holding these homes is great for the books. So I could see institutional folks selling and getting out of the market. There's probably validity to that, but honestly, I don't know.
And selling, you said 7 to 10% year over year.
Just values are down 7 to 10% year over year in some zip codes. So they're saying basically the data is claiming that there's this bubble like '08, right? There was the mortgages, the loose goose underwriting of mortgages led to this bubble because anybody can buy. Now investors, and we know guys in our circles that in the run up bought hundreds or thousands of single family houses and made a grip of cash. But to your point, I think if you're an institutional investor, maybe you're running a REIT, a fund, you have to, and you're buying single family houses, you're not buying off forced appreciation like we do on larger commercial assets. You're buying off speculation. You're buying with the expectation that you're going to buy low, sell high, and at some point you have to sell high, harvest the equity, and provide your investors a return. So I agree that they probably are selling.
That's not investing. That's speculating. Even Wall Street, even these big guys.
They speculate though.
If you're saying stock market speculative? No. Sorry.
Yeah. Yeah. If they're buying low, selling high, that is speculative. And I mean, I think real estate's local to itself. Like, I don't care that Atlanta's down 60%. Investor purchases in Atlanta are down 60%. What does that mean? There's 60% less investment properties being purchased. Like, every market is so different. So you need to be an expert in the market that you're investing in, or have a team in that market that you're investing in, or be an asset class expert. I mean, you guys focus on mobile home parks. I have mobile home parks. Like, you got to know the asset class and you have to know the area. I mean, okay, values in some zip codes are down 7 to 10%. I mean, sure. But I mean, I just sold some properties recently that sold for more than I tried to sell them for last year when they didn't sell. So it's like, you have to know your market and be in that market, or have people that you know and trust in that market, because nationwide, like national data, to me, in my opinion, is almost worthless. Like, I don't care about it at all.
Yeah, I agree. And I think that when you're talking, let's talk about, when I think of institutional investors, I think of Wall Street. I think of, real estate, investment trusts.
Funds, REITs, that kind of stuff. Yeah.
So these people are buying, they have deep pockets. There was a shitload of cash on balance sheets with private equity, like with these large institutional buyers, and they had to deploy cash. And so I think they overpriced. In fact, we have a buddy that does house flipping down in Sacramento. He crushes it. And he has a pretty good, at least, beat on that market. And he knows when to pull back, because he sees institutional buyers coming in and overpaying for houses. And I think a lot of these institutional investors had to deploy cash. They probably overpaid. They didn't have to worry about, we have to worry about cash flow. Our properties have to generate enough cash flow to cover the expenses and the debt service with money left over, because we're all about cash flow and freedom, right? They didn't give a shit about that. They had deep pockets. They were playing Wall Street, man. They were buying low, selling high. So yes, and they have to eventually sell to harvest the equity, especially when the values are inflated. So they're going to start selling. That's just economics. That's natural. Now, what is that going to do for markets? To Gabe's point, I agree. I think it's going to be very specific to the location.
Well, we're also up hundreds of percents from, I always go back to 2012, because 2012, I think it was right around like August or something, was like the sort of the bottom of the single family market as far as supply goes and prices go. A supply high, demand low, prices low. We've seen massive growth. We've seen a massive run up since then. And then certain markets go down 7 or 10% and everybody freaks out. And you're like, guys, we're up hundreds and hundreds of percentage, right? So huge growth. But now we're in this phase, or we just went through high inflation, right? High inflation, interest rates went up, costs have gone up.
Insurance costs are through the roof in many markets.
Yeah. The cost to maintain these homes, you'll get a quote on an HVAC now compared to 5 years ago. It's almost 2x. So of course we're going to see some adjustments, and the adjustments are going to be different in different markets. Just like Gabe said, like a lot of people are like, oh, the national market, there's no national market. Every single market actually has multiple sub-markets. So there's thousands of markets in the US. To see changes in that market, I don't think is surprising at all.
Well, what's interesting about this data, I was going back and I was doing a little more research to figure out which of these boom bust towns, which towns, like to Gabe's point, these sub-markets had the biggest booms and the biggest busts. In Florida, just state-wise, Florida, Texas, Colorado, areas of California. Florida in particular, Lakeland, Florida, has a 43% surplus of houses, right? Which is funny because I have a buddy that lives in Lakeland, and I remember before 2008, same shit happened in Lakeland. Same shit happened in Austin. Same shit happened. These are the same exact towns, some parts in Nevada. These are the same towns where there was all this speculation. People came in, whether they were individual buyers because mortgages were super easy to get, or there's so much cash on private equity balance sheets. They're just buying up all these houses in these markets. These are the same exact markets that they're talking about taking the hit that took the hit in 2008.
Because they're not buying on fundamentals. I mean, I saw this in 2008. You saw this in Las Vegas. You saw this.
I was part of it. I was one of the dumbasses.
Yeah, you saw it in Vegas. You saw it in Phoenix. A lot of these markets that had these big run-ups then pulled back really hard. And we just came out of a time where like interest rates were low and it drove prices up because buyers had access to low interest money. They had access to capital. It was easy to buy real estate. For syndicators, easy to raise capital. For non-syndicators, it was easy to give your money to other investors. It was easy to borrow, right? And so like, obviously that's going to drive prices up. If you look at like 2020, 2021, early 22, when interest rates were low, of course that's going to drive prices up, right? And so I think we're just pulling back to more of kind of a normal where things would have been had we not had all this cheap money in the market.
Well, these investors can't hold these assets forever. They have to sell, harvest the equity, and give a return to their investors. So there is going to be a sell-off.
Why? Is it because they had borrowed on short-term money?
No, it's because if I have a fund and I raise $100 million or $1 billion or whatever that is,
you need to pay your investors.
I'm investing people's pensions. I'm investing endowment funds. I'm investing family office funds. If it's a single family house, I can't provide a return through cash flow like we do. We buy assets, we force appreciate it because we control the appreciation through force appreciation. Every annual dollar of profit and a larger commercial asset increases the value 10 to 20 times depending on the area. Like we buy on those fundamentals, but these people didn't. They bought off of the speculation. I'm going to buy low, sell high, and they have to sell, especially when they're looking at, they're looking that they bought a house in 2012 or 13, 14, 15 at this price. And now the prices are up here. They have a fiduciary responsibility to their investors to exit, harvest the equity, to provide that internal rate of return, that IRR target that they promised essentially their investors. So there is going to be a sell-off. It's going to be a sell-off that's going to be a lot higher in some markets. The question is, for people that are listening to this that want to buy off fundamentals, buy cash flow real estate, hold it for cash flow, hold it for freedom, how is that going to affect them? What strategies should they be thinking about?
I'll tell you my opinion because I have a strong one. I mean, for one, it's not just Wall Street exiting. It's not just the big investors. It's also going to be the small investors that didn't buy on fundamentals that bought the same way Wall Street did, or probably a lot worse than Wall Street did, right? They bought at 3% interest, slim margins, hoping, thinking, wishing, which is not a strategy, that prices will go up forever. They'll be able to value add and refinance this thing at, interest rates will go from 3% to 2% probably. Or they stress tested it going up to 4%. They didn't anticipate rates doubling. So I like owning my own real estate. There's nothing wrong with partnerships. There's nothing wrong with raising capital, but I like owning my own real estate. The majority of my real estate, I own 100% myself. And I don't have to answer to investors. And I like that. I like, that when prices go down, my cash flow usually stays the same. And I don't have to be in a position to sell because I promise some internal rate of return to these 10 or 100 or 500 people. Again, real estate is a long game. You build wealth through real estate by holding real estate for a long time. So I actually have, when I look at buying something, I never buy something with the intention to sell it. I don't look out 5 years, 10 years. I'm looking out 20 years, 30 years, 50 years. I'm buying stuff, never planning on selling it. Not that I don't sell. I'm actually selling off a portion of my portfolio now, but these are properties I've held for a long time and I have strong equity positions. That's different than being forced to sell. When you're in a position where you can't hit a target and you can't pay your investor back and you're forced to sell, that's what's going to cause a big sell-off.
And well, that's big in single family houses because they cannot provide. Mitch and I raise capital. We have a small group of investors, we're a boutique private equity firm. But we buy assets that we know we can force appreciate. We know we can increase rents. We know we can reduce expenses. We can make them more efficient. When we talk to our investors, we say, we will give you this IRR target or we're shooting for this, but it's not based on us selling this thing. We tell our investors we're going to hold forever. Now, will there be capital events? Will we drive the equity up considerably through force appreciation? Yes. Can we refinance and harvest some of that equity tax-free and return capital back to investors? Yes. But we provide a return to our investors, A, through cash flow, number one, and number two, through capital events. If Mitch and I just went out and bought a bunch of single family houses on speculation, we would have to sell those houses. That's where you get the return for your investors.
That's kind of my point. We invest. I'm sure you have something to say, Mitch. Go for it.
Oh, that's all right. I was going to say, I mean, this is why I don't love single family homes. I think it's manipulated by institutional investors. It's manipulated by second homes. Depending on how the economy is going, it's manipulated by people. Yep, buying Airbnbs in a lot of these smaller markets. Airbnbs have changed the entire towns. So like buying single family homes and trying to get rich off single family homes, I think it's just by nature more speculative. You don't have the same control, and this is why we're in the multifamily market. I mean, some of these bigger institutional guys, they raised a lot of money when the market crashed in 2008, and they went out and they did okay. But it was still based on speculation that the single family market would recover. A lot of them made a lot of money, and I think now they're getting out. I think where the money's going is it's going to places where you can control your wealth. It's going to mobile home parks, storage units, potentially industrial. It's going to commercial real estate. And single family, we've shown over history, has just absolutely slapped people in the face over and over. Look, Lakeland's doing it again. So I just think it's a fundamentally a different animal. Now, the single family market's interesting to track because there's certain things that might affect us in the investment world, but it's just not an area that I feel like is conducive to scale into achieving time freedom and cash flow. I'd rather be in a multifamily asset.
Well, let's talk about how that does affect us, because people that are listening to this want to buy cash flow real estate long-term. If they're listening to us, they probably want to buy long-term hold cash flow real estate. If you have an oversupply of single family houses, in fact, we were talking previously about the silver tsunami and 21 million houses come on the market from the boomer generation selling off homes. Maybe this is investors selling off homes. If there is an influx of supply in the markets that we own, apartment complexes or mobile home parks or whatever the case might be, how will that affect us? And how will that affect our listeners that want to buy on cash flow fundamentals? Meaning, because there is some data that rents are flat or down in a lot of markets. There's been an oversupply, right, in some markets, right? And you couple that with increased property taxes, outrageous insurance hikes in a lot of markets, sometimes 4x, but due to weather events, fires like out on the West Coast where we're at. So you're going to get, buyers can get pinched. They can see cap rates slipping. They can see values decreasing. They can see cash flow reducing with higher vacancy, lower rents, and higher costs. So what can we do and what can our listeners do to prepare for a potential oversupply in their market?
Well, I think when we talk about oversupply, I really like and appreciate that you guys differentiate single family versus investment real estate, right? Now, I know people that kick ass in the single family investment real estate. They own hundreds of units, single family. Those properties do fine long term, but you have to differentiate. But I also think what's interesting is a lot of the single family homes that were purchased in the low interest environment, they're fine. Those are 30-year fixed mortgages. So I actually think there's going to be a bigger impact with all these loans coming due in the commercial real estate space. And when I say commercial, I'm talking multifamily, mobile home park.
5-year balloon, 7-year balloon, 10-year balloon. debt.
Because for our
Yeah.
listeners that don't know, most 30-year fixed 30-year fix is just that. It's 30-year fix. That mortgage is set for 30 years. And 30 years, that property's paid off. Usually commercial real estate is a 25-year amortization with that loan in place for 5 years. And then you have to refinance. And so I actually think the thing that people are not talking about enough, we're going to see a lot of these commercial deals come back to market. And I don't know what that's going to look like, to be honest, because people locked in these short-term, they bought properties with cheap money and now interest rates have doubled and it's not a 30-year fix. They have to refinance at year 5.
And their rents are down and their occupancies are down maybe, and their expenses are high and they're underwater. Yeah.
That is the big question. And I don't have the answer to that. I do think banks are going to negotiate. I think commercial lenders and banks have a lot more room to negotiate. They don't want those properties back on their books. But I think the single family, they're going to be fine. If someone bought an owner occupied home at 3% for 30 years, they're not going to sell their home. They're going to stay there. It's not the same as these institutional investors dumping property, but I am seeing small investors, medium investors, large investors trying to dump commercial real estate, again, multifamily and other commercial properties just to get even, just because they're afraid their rates they won't be able to refinance.
It's happening now, though. I mean, look at apartment complexes, for multifamily apartment complexes. They used to be the bee's knees. It was like everyone was just chasing apartments. And now multiple markets are bleeding. You got vacancy rates. People are giving deals for move-ins. I know, Travis, you're a little bit closer to this. Well, I think that there's not only an oversupply from the run-up, people pretty excited, but also you have adjusting interest rates. Just like you said, you buy an apartment complex on 5%, think it's going to save 5%, and you got to go adjust up to 6 or 7%. That's a massive,
especially if you overpaid
debt load. Right, exactly. So you didn't plan for that. So I think, we're also seeing the mobile home park space, not the same bleeding or desperation, but there's more deals today than there were last year. Absolutely. More people are ready to sell and willing to make a deal and negotiate. And versus in the beginning or even 2 years ago when the interest rates started to really pop, they just held. They held tight. They had these old values in mind. We've been able to get ourselves into better deals this year so far than last year. And so I do think that that's beginning. I am curious to see what that trough looks like and how far we go. Does it end up to where a lot of folks give back properties to the bank? I mean, some of it's happening now, but I think we've all been looking at that because we're fundamental investors. We go, look, there's so many people going to be in trouble because they're buying at 5% interest rate, right? Bank debt, and they don't have a delta. They don't have a cap rate that's well above that 5. They don't have enough cash flow to support higher cost debt.
Well,
so
Rich,
it is interesting.
Let me interrupt and ask you something. So when you hear Wall Street's they're exiting housing, right? Do you even care? Does it even matter? You bought investment real estate on fundamentals. Travis, you as well. Me as well. Do you care? Does it really impact you as an investor?
Personally, I don't care. I mean, I think that there's, following the headlines or being aware of things, I think that's fine, right? Reading that. But to me, here's the thing, if you're just throwing stuff at the wall, trying to make an investment, then you're going to be at the whim of the marketplace, probably, because you're not making a good investment. If you're focused on the fundamentals, you create your own economy. You create your small, tiny, little own economy that you control. For example, we're buying a mobile home park in Texas. We know that the area is steady as she goes. It's been steady as she goes for 20, 30 years. But we know that taking over that MHP, that mobile home park, we can implement the right changes, the right value add. We can drive rent towards market, and we can make really good money, really good cash flow, great IRR. We have great debt service coverage ratio, no matter what happens in the market or the single family market. It doesn't touch me. So yeah, maybe being aware of it's interesting, batting around what is this, conversating around what this thing's going to do is fine. But in the end, I don't think it affects me because I'm very, very, very focused on the fundamentals and creating my own economy. Does that make sense?
Fundamentals. Let's talk about, we're on a call. We're always talking to each other, and we talk with our elite group, and I do think there's a ton of value being in a mastermind or a tribe or a group of people that understand these things. I don't watch the news. I don't look at headlines. but I am surrounded by amazingly smart people in the investment world, in the business world that I can ask questions to, that can tell me things, kind of compress timeframes. Some of them are obsessed with the news, so they tell me this shit whether I want to hear it or not. And so I do think it's important to be around those folks. But I just wonder, like, what about you, Travis? Like, when you hear that, do you feel like it impacts you at all? Like my gut when I hear it, I'm like, oh,
I do. I follow the news. I let everything terrify me and support my narrative that now is never the good time to buy, because I look at national news and I make that a blanket assumption across the entire country because I'm a dum-dum like Mitch. No, I think real estate is very locally specific. There's such a fallacy in looking at these national headlines. And we've said this before, like if you're of the wrong mindset, which we're big mindset believers here in 0 to 100, and you have a narrative that it's risky and it's not a good time to buy, you're going to look for data to support that narrative. And I think that that's dangerous. I think that it is location specific. I think there are areas that are speculative, that have boom, that will affect us if there's an oversupply, especially in the apartment space. Like we love mobile home parks because it's essentially a diminishing supply, increasing demand for affordable housing. But I was joking. I don't care. We're buying in areas that don't ever have to have an influx. There doesn't have to be speculation that there's going to be a new Google plant that gets built there or a Tesla factory and that we're banking on that. We're buying steady Eddie markets. A lot of our stuff that we buy is in tertiary markets, decent supply of jobs at factories and, the Walmart supercenter down the road, et cetera. And if you're buying commercial assets, every commercial asset that we've bought, that's, again, for those of you that are listening, that's 5 units or more in residential, or it's mobile home parks or self-storage, all those things. I believe that you can you can plan your exit. Now that exit might not be selling. Most likely it's driving the value up so fast through force appreciation, harvesting that equity, returning capital to yourself or investors to go make another investment. I think that that's really what it's about. And if you know the end game before you start, which you should, and that's what we teach people in our elite mastermind, like you have to understand the fundamentals, you can create value. You don't have to hope that factory moves in. You don't have to hope that a bunch of people move to that area and drive up home prices and things like that. And if you are buying on fundamentals, you're going to have supply up, supply down, rates up, rates down. But the fundamentals haven't changed, man. People were buying real estate with double-digit inflation or double-digit interest rates in the 70s and the 80s. And those people are looking pretty damn smart right now because they took action.
And you know what? Like when I hear all this, I hear you guys talking and I kind of hear myself talking. I think about this. I think like those that want to get involved in real estate, like they want to invest in real estate, they need to have a clear vision of what that real estate is trying to do for them. Like, what is it that they want? Because we're after freedom. I mean, the three of us, it's about time freedom. It's about living life on our own terms. It's about, like we're clear on why we started investing in real estate. And it's not just it's not buy low, sell high. This is time freedom through cash flow real estate. So we can live a life that we want and how we want and where we want. It's the freedom piece. And I think I think Mitch, you said this recently, cash flow first, freedom forever.
I just said that. Yeah.
Yeah. That's what it's about, And so I think
smartest thing Mitch ever said.
Yeah.
Well, it's like every day. Yeah.
I like that though.
Well, again, so people that are listening, like, I think you can buy on speculation, a lot of different speculative points. You can buy on the hope for jobs. You can buy on the hope for population. You can buy on the hopes of demand increasing, supply decreasing. You can buy on all of those hopes, but I think you need to get rid of all the hope. And it's like when you build a business, you generally don't want to hope this thing's going to sell. You need a market fit, right? And I think if you're buying in areas that don't buy in maybe an oil town that everybody's going to vacate and the whole town is going to get boarded up because then all your renters leave. But if you're buying in steady Eddie areas and you're applying the income approach to valuations and they're all little businesses. And if you're increasing the profitability,
the whole fucking town. Mitch was talking about buying a whole entire town, and I think
we're going to call it Mitch Holeville.
That's your idea. Hey, I want to shift gears. I want to shift gears a little bit and get in a few more things before we wrap up this show. I just got done saying I don't watch the news. I don't care about headlines. But people in my life tend to send me things and tell me things that I don't need to know, but it's interesting. So someone sent me recently that Trump proposes to eliminate capital gains tax on home sales. And I think this applies to primary residences, but could or should this also include investment real estate? I'm curious your guys' thoughts on that. Trump's proposal to eliminate capital gains tax on home sales.
Yeah, I think that anytime you put more money into people's pockets that are out there producing value in our society, everybody wins. So I am absolutely for eliminating or decreasing taxes and putting more dollars in producers' pockets.
Travis, what about you?
Yeah, I mean, selfishly, people especially in our world, the investors, and we talk about this all the time with our elites and our crew, like taxes are the number one expense you're going to pay in your life and often overlooked. I think by design, I'm a bit of a conspiracy theorist. The government doesn't want you to think about that. But yeah, if you can eliminate a capital gains event, by the way, there's plenty of ways to avoid or mitigate or kick the tax can down the road in real estate. 1031 exchanges, bonus depreciation, opportunity zones. There are so many levers. Even if Trump didn't get rid of this capital gains event, selfishly, yeah, I would love for that to be completely eliminated. But all that's going to do is raise prices because that's a big expense, right? So your values are going to go up.
It will adjust, but I think it's just like going back to like the philosophy, like who do we in our country, who do we give the benefit to? Who do we take care of? And I tend to think that when you've got people that are growing businesses, owning real estate, improving housing stock, innovation in transportation or medical care, whatever, that all of our producers in our country need to be rewarded. So I think it just follows that. And if we reward all of our producers, the people who are actually out risking their houses and to create value, then you beat everybody. You have a country that's amazing. And so for me, that's just one example of how we could do that.
But so Mitch, in theory or in summary, believes in trickle down economics, which does kind of have a negative connotation. There's going to be probably trolls that listen to this and that doesn't work and damn
that's
you
fine.
and steal from the rich. But
bring on the comments. I'd love to hear.
Yeah, that's fine.
I'd love to hear our listeners' opinion. I mean, I'm of the thought as well. Like I'd always rather put more money in the people's pockets than the government's pockets. And I don't care if you like Trump, hate Trump, if you're a Republican, Democrat, or something else. I don't care. Almost always, in fact, always, I'd rather see more money go into the people's pocket and let them decide where that capital goes than the government.
It's a more efficient movement of capital. I mean, we know when the government...
People care about their money. The government doesn't care about
the government takes your money in the form of taxes. They piss all over it and they blow it. Look at Portland. There was $1 billion spent on homelessness. What's the end goal? More homelessness. So,
and as an investor, it's like, that's what you want. Like no capital gains on a primary residence. Hell yeah. That's great for the person that owns one home. That's great, right? Like instead of there being a cap, but for the investor, that's great as well. And not just selfishly because we're all investors, but because if you're not paying capital gains, then you're going to go deploy that capital. I know very few investors that just they don't want to just let money sit idle. They want to go redeploy that capital. And again, I'd rather have more money, Mitch, in your pocket, Travis, in yours, all of our listeners. Like, I don't care if you own one property or no properties or 1,000 properties. Like, I'd rather see more money in that investor's pocket to redeploy that into more deals.
Well, we're scrappy. We're creative. We're innovative. Like entrepreneurs are innovative. They're scrappy. They're going to improve, like Mitch said, they're going to add value. It's a more efficient use of capital than giving it to the government, which is then going to squander it, blow it, put it in their own pockets. Like I do agree. If you have entrepreneurs that have more money to then redeploy, like take real estate out of it, even business. If you have business owners that have more cash left over, they're going to invest in the new technology for their business. They're going to drive prices down, increase value. I'm a big believer in capitalism. I think that's why this country is great. And if the government swoops in and just leeches all of those profits out, the motivation's gone. Why the hell would I take all of the risk to start a business, all the risk to go take debt on and personal guaranteed debt and buy an apartment? Why would I do that unless there's a lot of upside down the road? And the government needs people to buy real estate and to create companies, to create jobs. They need that. They need housing and they need W-2 earners to pay half their income in taxes.
But the government, exactly, they think they need that tax. So it's like, I mean, I think just a couple
depending on who you talk to, yeah.
Just a couple weeks ago, Mitch and I, we were recording a podcast episode and we were talking about eliminating property taxes. And you were like, but I like nice roads and I love to fund all the schools. And Like
it sounded just like that too, like a bleeding heart.
I think I got some heat because I had someone message me because they said I had an attitude about because I said something like, I'd rather have shittier roads and something to blow up the school system than property tax.
Not physically blow up the schools. But yeah.
Did I say blow up the schools?
Yeah, I just wanted to clarify.
Dismantle,
disrupt the education system.
Dismantle the education system. Wow, you gotta be careful.
Oh my gosh, we gotta edit that one out.
No, we'll keep it in. We'll keep it in. We'll let our editors decide. But I do think, again, it goes back to yes, there's a place for government. I don't believe in full anarchy and full chaos, but I am a big believer that people, the individual person, and the collective of people in this country have the ability to do great things with their money and with their resource and with their resourcefulness. And I'd way rather see that because time and time again, the individual person and people have done more with their capital than the government has.
Well, when you look at when you go back in time and you look at in other words, I think we have a hard time conceptualizing this because we have 350 million people in our country. But if you take a village of 100 people and 10 of them are the ones who are out creating things, they're out hunting, they're out gathering, they're grabbing, they're building, they're creating new weaponry, they're producing. I think it's easy to look at that village and go, look, let's give these 10 people more resources because they're adding value to whatever, right?
Weapons?
They're well, potentially. So
look at this.
So they're going to give you're going to give those 10 people more resources though, right? Because they are providing value for the other 90. But then when we go into our normal,
I think we need to redistribute their wealth to the non-producers.
We go into our normal economy, and for some reason, we think that it shouldn't be like that. We've got to reward the people who are helping everybody else.
Well, here's a good example. Let's say a guy like Elon Musk, hate him, love him, hate him, bash out his cars with the bricks, whatever. At the end of the day, if a guy like Elon Musk, who's a brilliant mind, you can't argue that what he's done and the innovation that he's brought to this country through space travel, through driverless cars, through all these things. If he was looking across the globe for a place to innovate and to grow and provide value, and he was sitting in a socialist country that basically villainized you and punished you for success, he would not stay in that country and create value. He would do exactly what he did. He would come to the United States and he would create
that migrate to places where they can go create value.
This is also why he's probably trying to colonize Mars.
That's a good point.
Well, yeah, the bigger the problem you solve, the more money you make. And I don't think you should villainize people like that. And I think if you create an environment, an economic environment where the scrappy, the innovative win, then everybody benefits from that. Lower prices, higher value.
Elon's also predicting universal basic income as AI takes over. We could do a whole, we're getting off topic here, but how that's going to impact. We could do a whole show on how universal basic income will change all things for all people. And it probably is coming with the takeover of AI and robotics and everything else. And we should probably do a whole show on that and how that's going to impact real estate in particular.
Well, I want to go back to just for 1 second, because I think that, and for the bleeding hearts that are listening to us going, well, what about social programs? What about taking care of folks with disabilities? What about all these other things, schools? I think that we can have it all in this country if you have one thing before the other. If you have people who are producing and creating value and driving tax revenue and putting it in the right places and it's managed efficiently, I believe we can live in a country where nobody with disability is on the streets. We have schools that are amazing. We've got to take care of our producers. The producers create value and create resources, and we put the resources into places that matter. I think we could have free childcare in our country. I think we could do things in our country that are incredible and are a little bit left-leaning, but because we're taking care of our businesses and entrepreneurs, they create such massive value that we're overflowing.
Well, there's a whole term for that. It's like social capitalism, right? Like you look at a nonprofit, they're all nonprofits are staff constrained. They can't pay their people. They're resource constrained. And what they can do is finite. Their heart's in the right place. But when you take social capitalism and look at a guy, love him or hate him, a guy like Bill Gates or some of these people that are giving billions and billions and billions of dollars away, they're creating a lot of value around the world.
I'm cheering for everybody to win. It's like any
Me too. Absolutely.
I feel like anyone we mention, we're like, love him or hate him.
Love him or hate him.
Hate him. But
like Mitch, hate him or hate him.
Love him. Hate him or hate him.
Hate or hate him. All right. So to tie this back, for those of you that are listening, okay, capital gains, no capital gains. Investors, institutional investors are dumping all this real estate. highs, lows. The one thing that's guaranteed is that shit's going to change on a short-term basis all the time. But we're talking to our people about buy on good cash flow fundamentals. Make sure you have responsible debt, whether that's being underleveraged or having sufficient cash flow to cover your expenses, your mortgage. Don't buy on speculation. Buy for the long term. Buy an asset that you can control the outcome through forced appreciation, which isn't necessarily single family houses, maybe to an extent, and just stick to the fundamentals. Create lots of cash flow, create freedom, retire, and then you can go be philanthropic and you can go volunteer your time. But
I love it.
Take care of yourself and then take care of everybody else. Your own oxygen mask first, then everybody else. Sure.